Welcome to my channel. I'm the cover call guy, and today's video is requested by Greg K235, leaving a comment asking how cover call ETF investors tell the difference between NAV erosion and price action. Greg, simple. I could do this in 30 seconds and say if the NAV drops every time there's a payout consistently, run. Don't walk, run away from it. But I'm not going to do that to you, Greg. And anybody that's new to the cover call field income investing side that just found my channel, I'm not going to do that to you too. Welcome to the channel. Welcome to, this side of investing, income investing. I'm going to try to break it down, make it simple, make it easy. But before we get started, let's do a legal disclaimer. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I'm just some random idiot you found online and I could be completely wrong. All right, with that out the way, let's get started. All right, the forensic analysis of cover call ETFs. We're gonna do it. We're gonna break it down Sherlock Holmes style. We're gonna just go with our magnifying glass, go step by step and look. Right, we're gonna break it. We're gonna break down structural NAV erosion from market price action. That's again requested by you, Greg K235. Thanks for leaving that comment. Appreciate it. All right, so is it a yield trap, right? Is it your income or is it your principal? Easiest way, like I said, if the NAV goes down every time you get paid out, this is a fundamental sign of erosion. The fund's price return lags your distribution rate. The core risk you face with high yield ETF, by definition, yes, I know 10% might not be high, but it is. Outside of that traditional 1 to 5, maybe even pushing 7 with the BDCs and CEFs stocks, these are considered high yield. Once you get up that traditional 1 to 7%, even 8%, that's even considered high. All the way up to 100 to or more than 100% in some cases, right? The biggest flaw, critical risk you face, structural NAV erosion. What that is the fund is paying your distribution by systematically liquidating its own asset base. Painful math, but simple math, right? If the price dropped 50% and you collect 12%, you lost 3% of your wealth. The fund is paying you with your own capital. And on top of that, you don't even see the expense ratio you're paying being paid out because it gets paid out, I believe, annually every year. But from the stock price, from the NAV, I have to double check on that. So you won't even see it. You won't even feel it. So you're getting, and then on top of that, if it's not 100% return on capital, you're paying taxes on it. So that's like a double, triple whammy right there, right? You gotta know the difference between hedge finance, which is true income, and Ponzi finance, right? Principal liquidation. They're just taking you guys. If you own these type of ETFs, all you're doing is buying these guys a new yacht every year, and a new beach house in Miami every year. I I don't want to say it. I mean, I'm gonna get hated for it, but it is what it is, right? So we're just gonna compare these top three to the bottom three, right? So the top three versus bottom three, and basically how you read this chart, how it's made is the chart visualize the core conflict. You see that the healthy funds, quote unquote, okay, these are examples. I just have them out there. There's examples. Don't be throwing, shade and being like, oh, you gotta pick better one. These are just examples. JEPI Devil has a positive NAV despite moderate yields. Yes, it's moderate. Now, versus the destructive funds, TSLY, QYLD, right, demonstrate the inverse. Their high yields are consistently paired with negative NAV, confirming they are systematically destroying your capital to make the distribution target. Again, these are examples. In my opinion, sustainable strategies, what you should be seeking, right? JEPI, JEPU, Devil. For my verdict, it's stable, rising NAV. Maybe not the last 3, 4, 5 days, not the last week, but overall, stable, raising NAV. All right. The only risk is that yes, sometimes they sell out the money and they use ELNs, which is very very tax inefficient. But for the most part, they preserve your principal and allow some upside capture. Versus the erosive strategies, right? My danger zone kind of to avoid. You don't want to be owning these if you don't have to. QYLD, XYLD, TSLY. I'm gonna say the declining, crashing NAV, slow burn. Right. So You might not feel the pinch now, but you will eventually feel it. They sell at the money, synthetic and capping 100% your upside, and you'll feel 100% of the downside. And then we also got to talk about the cost basis trap, right? How rock destroys your cost basis. Return of capital lowers your cost basis, converting your principal into taxable capital gains when you sell. So as you see, you purchased it $2,000, and then year one it goes down, year three, and then year five, and then you're possibly looking at paying some taxes. Even if you don't sell, you're probably gonna look at into hopefully it depending on how they pay out. I mean 60/40 original or not original, ordinary income. It just depends. Every ETF is different. I can't speak for it. All right, and then part two, right? The big red flag checklist, right? This is the Sherlock Holmes detective kit, right? We're gonna be looking for clues to tell us if a fund is really making money or just pretending, right? Each clue is gonna be each clue is a big red flag you need to watch out for. All right, so we're gonna start with this list: the money lost and tricky payouts. Right, the slipping price, like we said, right? The fund's price keep going down a little bit each time it tries to go up. It never gets back to where it started. Right, the inception price too. It just go down, down, down. The fake income trick: the fund pays you money when you add it up. When you add it all up, the fund actually lost more money than it paid you. They're just giving you your own money back. Like we mentioned before, right? The unfair game. When the market goes up, your fund barely moves. When the market falls, your fund drops super hard and fast. The shrinking money jar. Over a few years, the total value of everything the fund owns is getting smaller, not bigger. This is not income, right? You keep getting these special papers from the government saying big part of your income is just money that returns to you, your own initial investment, which is basically you check the section 19A notice. Those are just estimates. They're not 100%. They could be lying to you. You won't know until end of the year, so you have to be careful of that. All right, the sneaky tax trap. They give you back your own money. They quietly make your original investment price look smaller. This means when you sell later, you might pay more taxes. Right? You gotta look at your tax form to check that paying out too much. Is the fund giving out more money as payout than you actually earn from investments? Spending more than you make is not. It can't last. It's not sustainable. The empty cash box. The fund has no extra cash saved up from previous earnings. It's actually borrowed from future money to make payments now. Fixed payments. They promise you to send you the exact same amount of money every month, no matter if the fund made a lot or little. Obviously, this is unsustainable, right? I mean, they're simply forced to dip into your principal to meet the payment if earnings are low. So how long can they last from that, right? I mean, it's common sense at this point, right? And then they play the tax games, aggressive tax loss harvesting, right? They will tell you, you can see they will make an announcements, and or you see it on your at the end of the year, when they make their filings, you see that the fund sells losing investment just to create losses on paper, which reduce their taxes, but often mean you're stuck with a fund that keeps making bad calls. Not a good sign. And then the fund management and hidden dangers, right? The big reset button, reverse stock split. You see this? You saw it recently. I'm not gonna keep naming names because it feels like I'm just targeting. But if you just Google, recent cover call ETF stock splits, it will pop up. That just means the fund lost so much money that it had to squish 10 of your shares just to make one, to make the price bigger. This is a giant screaming red flag because it's cosmetic. They're just painting and putting makeup on a fund to make it look nice, but deep down, once you remove the makeup, it is rotting, right? The option tax problem. The fund uses complicated options, but the cost of keeping these options going, like paying rent, eats away all the money they should make from them. So it's a zero net gain, or even worse, negative. The invisible money drain. The fund uses fancy synthetic method that act like they own the stock, but these methods actually cost money every single day, slowly draining your principal. No safety net. If the stock market suddenly crash, The fund has no plan or special insurance to protect your money. The leaky bucket fund. Even though new people are putting money into the fund, the total amount of money it manages, its assets under management, is getting smaller. Huge red flag if that happens. Run. Take your money out, run. The fund is losing money faster than it's coming in. Marketing hides the truth, right? You see some of these covered call ETFs have great marketing. Amazing, right? That should be suspicious already. You're spending so much money on marketing, right? You should be spending more money on building a goddamn team and hiring someone with good strategies. Super high fees. The fund charge you a high amount just to manage your money like a super expensive babysitter. Anything over 1% is usually too much. I would say anything over like 0.68% is too much. Smart people are leaving. Many big clever investors are betting against this fund or they're taking money out. They see problems. So if a lot of people are talking about it, there is some truth into it, right? There is some truth in the echo chambers. Sister fund disappearing, other similar funds managed by the same people have shut down or have been closed because they failed. Ooh, yikes. When you figure out once these people fail at one thing, they create the next shiny thing, and then they fail on that and they try to do it again. Changing their story a lot. The fund manager keeps changing how they invest their money every few months because their old plans didn't work. Again, I'm not going to be calling out any ETFs and cover call funds, but if you Google, you will see some of the funds do this a lot. What is that animal that changes color? Chameleon, right? It just changes. It's trying to be a different person every time, a different fund, but it doesn't work. It doesn't work. And then, of course, these are some real world examples of erosion, right? The volatility trap, TSLY. Lesson here is that the asymmetric risk, cap gains, full losses guarantee over 50% NAV erosion, even when the underlying stock, TSLA, is flat. You saw the results. A reverse split was required because it would have been delisted. It would have been kicked off. Crazy, right? It's not, sometimes stocks, a reverse split is not good. And then we go into the slow bleed, QYLD. By selling at the money cost, the fund captures 100% of the Nasdaq's growth. Your NAV drops from approximately $25 to $17 during a massive bull market. This is how you lose principal over time. As you see, the green line is Nasdaq and the yellow dot is QYLD. And it just keeps dropping. Again, all of these is real life data. It's just the pictures here is illustrative. It might not match the actual. I just use the numbers here differently because it's easier to visualize. And of course, the survivor bias, right? That just means that just because 50% of the fund got delisted or liquidated, and the surviving 50, you think that surviving 50 made it out, doesn't mean that. It does not mean it's good. It just means it survived. It could be, by barely, by the margin. So how do you choose good cover call ETFs then? That is a good question, right? Well, you can do that by one, understanding their strategy, two, looking at the underlying, and three, how they execute during a bull market and a crash. Those are three very important factors. Does their NAV actually grow when the market goes up? It does. Good sign. Does the strategy work in a choppy market when it's flat? Well, the NAV stayed the same or it grew a little bit. Good sign. What happens in a down market? Did they kind of allow? Did the premiums get higher? Did the stock drop? Did the stock, if they own the underlying, the stock will drop, but how much did it drop by? Not a lot. Good sign. So don't just pick the winners just because they survived being liquidated. You have to actually understand what's underneath these cover call ETFs. And my verdict here, right? 10 questions to ask yourself, right? Cover call, is it at the money or out of the money? At the money, I would say it has higher erosion risk for you. What is the upside capture ratio versus the underlying index? Has the fund ever executed a reverse split? What percentage of this distribution were return of capital? Sometimes 100% of return of capital, yes, it's you don't get taxed for that. It's tax deferred, 100% of it. But I personally don't always want 100%, right? If you give me 80% and a 20% is, um, the um, options, premiums or dividends, and it's still, tax efficient, I'm okay with that. The reason behind that is you're showing me that the fund is actually making money, that you don't have to have 100% return on capital. So that's a good sign too. Now, if it's 100% return on capital and they have consistently maintained a NAV, then that's a very good sign. But there is always a risk behind that. I would much rather go 80 to 90% and even 70%. I'm fine with that. That just means the fund is doing really well. They're making good profit and they don't have to give back 100%. They're using the other money to do something else with it. If the market drops 20% and rallies 20%, where will your NAV be? You have to track it, right? Does the fund use synthetic positions? What is the cost? How does total return compare to selling 1% of the stock monthly yourself? Right? You got to do those hypothetical kind of calculations yourself. Is the manager active or passive? Rule based? Does the fund hold any protective puts? Downside buffer? What is the fund's volatility? The standard deviation. How does it uh, match up with the Nasdaq or SPY? You know. And in my verdict, if the NAV has to erode to get the payout, it is not an income, it is a partial liquidation. Run! Like that meme, run, bitch, run. While it's not fraudulent in the legal sense, right? Funds exhibiting these signs detailed above operate on a mechanism that transfers wealth from the principal balance to income column, often destroying value in the process due to fees, capped upsides, and tax efficiency. You're getting a triple whammy there, right? You're getting slapped front backhand and the other hand, right? If you are invested in these type of stocks, right? These type of cover call ETFs, you should treat it as a tactical tool for sideways markets, never as a set and forget compounding machine. And what I mean by that is that you should be using these as a in and out on a daily basis, like you're buying in, you're getting out the next, like within the same day, or at most you're holding them for a week or maybe 2 weeks. You're using this as a tactical tool. You get your profit in, you get out. You let it dip, you buy in, it goes up a little bit, you get out. That's what I mean by it. So yeah, hopefully this has explained a little bit. If it didn't, let me know. But yeah, I think this was enough information. I try to keep it short, but it wasn't. I probably should explain things a little bit better. But I hopefully it was good. I mean, the simplest way is if the NAV is going down every time it pays out, that's a bad sign, especially if it does it consistently, right? So a 3-year time frame, if it went down a full year, it would just keeps going down, but the next 2 years it went back up and caught up. That's different. You're gonna have downturns. You just have to keep track of the downturn, and then when the market goes back up, you have to keep track if it actually goes back up. Now, if it doesn't, that's when you should cut your losses and just get out, run, go into a different cover call ETF. Thanks for watching. I hope this was informational. I hope it helped. Again, I appreciate the comment. Thanks for watching. Comment, like, subscribe. Catch you guys in the next. Stay tuned.